Welcome back. With consumer and business confidence at low levels and the Abbott government's popularity still putting the PM under pressure, does economist Saul Eslake of Bank of America Merrill Lynch think the Reserve Bank is set to come to the government's rescue with another interest rate cut on Tuesday after Easter? And should it be pointed out that Saul has actually tipped that interest rates will rise by the end of this year? He joins us from our CBD studio. Hi, Saul.
Hi, Peter.
OK, I don't know if you realise I have been playing around with that new television program, Better Call Saul. So you're our Saul, so we've called you.
Well, thank you. You're not the only one.
I didn't think so. Now, listen to this, mate. You have actually made this call that you think interest rates will rise by the end of the year, or you've been reported as saying that. Do you think the Reserve Bank's going to cut in April?
No, I don't, although I think they may well cut in May. The last communications from the Reserve Bank have all been about saying there is a case for further easing which will be considered at subsequent board meetings, but will depend on the data. And we haven't had a lot of that over the last month that shed any new light on the economic situation. And I think it also probably depends on what happens in housing. And again, we don't have a lot of new information on that either, although there's a lot of anecdotal evidence to suggest that the rate cut in February has triggered a renewed spurt in demand, especially from investors for property, and that's pushing prices up even further. We'll get some new insight into that tomorrow morning, of course. And that goes to the question of why I have the view about interest rates that I do. I acknowledge, as many of your viewers will no doubt remember, that I was wrong about the Reserve Bank in February. I didn't think they were going to cut rates, and they did. I thought they should have cut rates last year, and they didn't. Yeah. And I think they are potentially making a mistake in cutting rates now, because what it will do is give further stimulus to the one area of the economy that doesn't need any more stimulus, namely housing, whilst not doing a great deal to support those areas of the economy that could do with some more help, because lower interest rates aren't what those areas need. What they need is a lower exchange rate, and I think they will get that by the end of this year. And it would probably be helpful if there was some additional discretionary fiscal stimulus, some more spending on infrastructure, which Mike Baird now has a mandate to do over time, but no one else in Australia seems really all that keen on.
OK, so Saul, but if they cut rates, say, for example, in April, that would help the currency go down, wouldn't it?
Well, would it? I mean, this is what a lot of people believe, that cutting rates contributes to pushing the currency down. But, for example, the currency isn't any lower today at just under 78 cents than it was just before the Reserve Bank cut rates in February. I mean, what happens to the Australian dollar depends a lot more on what the US dollar is doing than on the level of Australian interest rates. And my own argument for some time has been that the main reason why the dollar has been as strong as it's been relative to other currencies in the face of a falling commodity price structure has been the massive capital inflows Australia's been attracting to finance the resources boom, and that since this is the year in which the resources investment boom starts to come to a close with the completion of work on 4 of the 6 gas plants and then the other 2 next year, all those capital inflows are going to dry up and the dollar's going to fall irrespective of what the Reserve Bank does with regard to interest rates. So I share the objective the Reserve Bank has of wanting to get the currency down, but I don't think they need to take the risks they're potentially running with the housing market in order to achieve that objective.
But hang on, Saul, you're not a Sydney sider. You reside in Hobart or Tasmania, at least. Why do you care about Sydney? It's only one market. All the other markets, Melbourne's a little bit hot, and also Sydney was what? It grew at 2.5% over a 10-year period. You're just picking on us because you come from Tasmania.
Oh, not at all. I mean, Tasmanians would probably need a lower exchange rate even more than the New South Wales does. And as I say, I think we'll get one. But Sydney is certainly hotter than elsewhere in the country, and it's a good thing that Sydney's getting an above average share of the new building that's happening because Sydney has lagged behind the rest of the country. That's one of Bob Carr's legacies, of course, the Sydney is full mentality and migrants please go away. Now that's being corrected, and that's a good thing. But in my view, no great good is being done by having further increases in household debt, and we learnt last week from the financial accounts that household debt has struck a new record high as a proportion of personal disposable income in the fourth quarter of last year. Something like 70% of the increase in household debt since the September quarter of 2006, when it troughed, has been borrowing for investment property. Over 90% of that borrowing goes into pushing up the price of established housing rather than adding to the housing stock. A lot of the increase in new building that we're seeing is coming from foreign investors, not from Australians. And because people aren't willing, as they once were, to borrow against increases in the value of their own properties to spend more broadly in the economy, then the wealth effect that used to exist as a result of rising house prices is much weaker than it used to be. So, as I say, my view is that the Reserve Bank is taking a risk that I don't think it has to, further stimulating the one area of the economy that doesn't need any more stimulus, and not doing much, as Phil Lowe admitted a few weeks ago, and Glenn Stevens a little before that, that lower interest rates don't work as effectively as they used to in these other parts of the economy. What would do more would be a lower exchange rate, which lower interest rates on their own aren't bringing about, and in the short term at least, perhaps some discretionary fiscal stimulus through more infrastructure spending. And as I say, full credit to Mike Baird for being willing to do that and gaining a mandate from his electorate for funding it, but there's not much appetite for that anywhere else in the country, it would seem.
Well, Saul, we are hearing the Prime Minister and Treasurer kind of infer that this budget's going to be a lot softer than the one before, and I'm kind of hoping that they're going to push some infrastructure spending. But are you implying to all those people out there who are wringing their hands and desperately scared about the budget emergency and the debt emergency that really we can afford to spend a bit more fiscally to get this economy growing?
I think we can afford some short-term fiscal stimulus that creates longer-term value, which I think is what Mike Baird is trying to do. But frankly, I'm worried about the new direction that the government is taking in the lead up to the budget, because they seem to be suggesting that the debt emergency of which they spoke wasn't an emergency after all, and that they can relax on the long-term challenge of fiscal consolidation and instead create some new entitlement programs for families and give small businesses what is for each individual business a relatively small tax cut of 1.5 percentage points, which of course won't benefit unincorporated small businesses. It will only benefit those who operate as companies. But because there are so many small businesses, it costs a lot of money in terms of the budget being concerned. So what I've been saying for a long time is that the government ought to be trying to achieve two tasks with its budget. And Joe Hockey got this last year. One is to provide support to growth in the short term, and infrastructure spending is the best way of doing that, not creating new entitlement programs, but pressing on with a longer term task of, as the Prime Minister said on election night, putting the budget on a credible path back to surplus, but doing it in a way that the majority of Australians regard as fair, which is obviously where they fell down in what they tried to do in last year's budget.
So, always great to talk to you, mate.
Thanks very much for having me again, Peter. I enjoyed it too.
My pleasure. It's time to put some stocks under the Paul Rickard microscope, and tonight we look at Fortescue following Andrew Twiggy Forrest calling for a virtual cartel for iron ore producers, and we'll look at the share prices of the big four banks if the Treasurer introduces a bank deposit tax. Paul, good to see you.
Hi, Peter.
Let's start with Fortescue, because that was the controversial issue last week, and also Michael McCarthy thinks Fortescue looks like a buy at these levels.
I think that's a pretty big call.
I thought you might say that. So you don't think... what worries you about Fortescue?
Look, I'm still worried generally about the iron ore market and any iron ore producer. And look, while BHP and Rio or even Vale and from Brazil are intent on increasing production, which they are, we've got a supply glut in iron ore, and being in the iron ore business is pretty hard work. And I think for Fortescue, which is a relatively new entrant, now number 3 in terms of our iron ore producers.
There's a chart there, Paul. It doesn't sort of... Michael McCarthy's being very courageous picking Fortescue at
these levels. It doesn't say buy me yet, does it?
No, it doesn't.
I think it's a very courageous call. Look, Mike might be right for a short-term trade. I mean, it was down 3.7% today, so look, these things can bounce very quickly. But in the short term, I can't see why you'd be investing in in the iron ore miners.
Are you selling your miners or are you just holding?
Look, I'm underweight. I'm staying underweight, and like, you know, as we keep on talking about, and particularly about resource stocks, I have no, you know, silver ball. I don't have no crystal ball that says where the iron ore price is going to go. And I think anyone's surprised by the extent of the fall. But what's very clear is the production keeps going up, and this is really as much a supply issue as it is a demand issue. And while supply is where it is and keeps on and is increasing at the rate it is, I can't see what's going to turn around. And I think, you know, for some ways, obviously what Mr. Forrest said last week, you know, price fixing and cartels is illegal. There's no doubt about that. But if you wore your sort of national interest hat, you've really got to question whether he might be on the mark here. Yeah. And I think shareholders are entitled to ask both BHP and Rio, have they modelled what would happen if they didn't increase their production? You know, rather than, you know, if they just scaled it back a little bit, what would happen to the price? Have they modelled that? And are they really confident that this sort of massive sort of production glut that's occurring is the right strategy?
But in a sense, they can't discuss it because that's collusion.
No, they can't discuss it publicly. That's collusion. And but they can at least ask us some shareholder questions and say, well, look, if you know, BHP, if you held production back at 2013 levels, what does your forecast say for the iron ore price?
Okay, good.
I think we could do some sums. So I think they need to do a bit more study of game theory. You know, that's what this is all about. It's a game with the Chinese producers. It's a game, the Chinese steel producers. It's a game with the other iron ore producers in China and other parts, the high-cost producers, to see what's going to happen.
OK. Market was down today. How did the banks do today?
Look, banks came off a little bit, followed the market down 1.2% for the banks index. Interestingly, the banks are still holding up pretty well. On a year-to-date basis, the market, if you look at the accumulation index, that's what we should talk about. That includes dividends. It's up 9.47%. The banks are up 13.35%.
So all those people who were saying banks were a bad buy last year and we said we disagree, we were right.
We were right. They were wrong. They continue to be wrong. I mean, I'm a little less circumspect about the banks. I'm back to index weight on the banks because I think that they are going to, you know, the recommendations of the Murray report can't be ignored. Eventually that they'll have to start to, you know, they will be increasing their capital base a little bit through in the short term by not neutralising their DRP plans and a few other things. So, look, I think there's going to be some more bank shares around, and you've got to be. It's time to be a little bit closer to index weight. But while interest rates are low, you know, it's not the time yet to be massively out there selling your bank shares.
I'm sure people read the weekend press and saw that the Treasury was thinking about a bank deposit tax, and they might have thought, well, what's going to happen to my shares? Do you think there'll be implication for the shares?
Well, look, I don't think this is going to get up. I mean, let's just remember, we had what was called Financial Institutions Duty, FID. It was a state tax. We also had what's called a BAD, B-A-D,
the bad tax,
debits tax, the bad tax. Both of those things went with the GST in 2000. Okay, all the states kept to their word and abolished those taxes. They were silly taxes. They used to drive people nuts having to calculate the FID on when you made a deposit.
When you were a banker, you had to calculate it all the time. Poor old Paul Rickard.
Well, we had a few more sophisticated computers. We calculated this. People hated them, right?
Yeah.
Look, this came up a couple of years ago. It was originally a recommendation from the Labor Party. They went a bit quiet on it. It's come back as a result because of the argument around whether, you know, bank deposits are effectively guaranteed. And it's.
Do you approve of that?
Well, I think the guarantee could be reduced, but at the moment, you know, you're mad if you don't understand that on a per
it's still
account,
is it
$250,000 per bank. So you can have $250,000 in one of the major banks. You can have $250,000 in
a credit
Rabo, you have $250,000 in a credit union, you have $250,000 in a building society.
If you've got lots of 250,000, you can go lots of different institutions and be safe.
And it's all government guaranteed.
Right.
You know, so
Love that.
You know, why would you not invest in a term deposit which is government guaranteed?
But Paul, don't we like because the world knows that the government's standing behind our banks, doesn't that also help us when we borrow as well? That or as borrowers, we are safer from the point of view that our deposits are actually guaranteed. Don't we get an interest rate benefit from that?
Well, we do. I mean, and clearly it helps in particular the smaller banks. I mean, the smaller banks probably fight hardest about this stuff, but you know, if
they borrow cheaper
because people like you and me say to clients who've got a bit of money, well, if you've got more than $250,000, why would you invest in Bank A versus Bank B? They're both government guaranteed. If Bank B is offering 0.5% better, If you can stand the hassle of opening a new bank account, why would you not go to Bank B? So I think they're actually a huge beneficiary of this. Look, I think this is one of these dumb ideas that gets circulated. In fact, David Murray in his financial systems inquiry looked at this idea. They recommended against it. They said there are better ways to actually make the banks pay for any guarantee. The Greens have come along today and said, I will support it for the 4 major banks, but not the minor banks, which is just madness again.
Crazy.
I hope this thing gets buried and we don't see it again.
OK. Now, we've got a viewer question as well, Paul. It comes from Susan. She writes, left very alarmed and despondent by an article in The Australian this morning by Adam Crichton. He actually corrected me last year on the show. And basically it was about possibly the government taking away imputation credits. What do you reckon, mate?
No chance. No chance whatsoever on this one.
So Susan shouldn't worry. It's just a journalist article in a newspaper.
Well, no. Well, it's a journalist article based on the tax review. So the tax review is a paper that's been published today by Treasury. Yeah. And it's listed all the different taxes and all different ways that government could raise money.
Like getting rid of negative gearing.
Like getting rid of negative gearing. That won't happen. Look, a tax here. Look, on dividend imputation, again, is not going to happen.
The share prices would fall, wouldn't they?
Well, they would. And you remember just 7 months ago, 8 months ago, or about 12 months ago, sorry, when the paid parental leave had a bit of coverage.
Yes.
And one of the issues with the paid parental leave was that big companies were going to pay an extra levy of 1.5%. And as a result of that, the imputation credits would be marginally reduced. So big companies would pay tax at 30% and only be able to provide imputation credits at 28.5%. Yeah. Right? Tiny little change.
And people were so cheesed off.
Yeah. So to now think that they're going to drop imputation credits, it's not going to happen. Look, it's an idea that's been floated. There's a question about equity for, it's an argument that maybe foreign companies don't get the benefit and aren't as attracted to invest in Australia. I don't think it's going to happen. Don't worry about it.
Yeah, and we're not lacking capital inflow. In fact, we get too much capital inflow.
At the moment, no one really wants. But let's be careful. We need foreign inflow. Yeah. We need, because we run a current account deficit. Someone's got to fund it. It's got to be from offshore. But at the moment, foreign capital is not particularly popular out there in many of the streets of Sydney and Melbourne. No.
So that's Paul Rickard. Paul's actually been boasting that one of his articles on the Switzer.com.au website actually attracted more readers than me, and he's been boasting about it all week. So I thought I'd give him some public praise for him being such a good writer. Paul, thanks for joining us on the show. After the break, we'll test out these housing bubble claims with a mortgage industry leader close to the real estate coalface.